Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So first of all, I must apologise because I've got a stinking cold as I make this show, but I will soldier on regardless. Now, it certainly isn't a boring time to be investing, with this week seeing a number of historic market moves, and perhaps it's only apt that it's 22 years to the day since the dot-com bubble peaked. And just like then, there is a feeling that this week we are experiencing historic moments in the making in investment markets. Now, firstly, commodity markets had their sharpest weekly rise on record, and that's going back more than 50 years. Now, natural gas prices hit a record high, while the price of a barrel of Brent crude hit a level not seen since 2008. And that was principally a result of a ban on Russian and oil imports by the UK and the US. It meant that the price of a barrel of Brent crude touched $139 a barrel briefly before pulling back after it became clear that Europe was unlikely to join the embargo on Russian oil. But the historic moves in commodity markets spooked equity markets at the start of the week, especially in Europe and in particular in Germany, which has a heavy reliance on Russian energy. Now, at the start of the week, the German DAX officially entered bear market territory, which means that it had fallen 20% from its recent high on the 5th of January. And the move was repeated across European equities. But more broadly, risk assets were a sea of red wherever you looked. But in a sign of just how broken markets seem to be right now, bonds continue to be seen as a bit of a risk asset rather than their traditional status as a haven asset, due to the backdrop of inflationary concerns, which have been fueled by the meteoric rise in commodity prices in the last week. Now, to give you an example of just how much prices have risen, the average family car in the UK will now cost around £90 to fill. Combined with rising fuel bills and supermarket prices, as commodity prices remain elevated, consumers are feeling the squeeze. And the concern is that central banks will be forced to raise interest rates in this environment in an attempt to control inflation, but at the same time risk sending economies, particularly in Europe, into recession. Now, if you take the 10-year US Treasury yield as an example, it has risen from 1.688% to 1.955% this week. And that means bonds have tumbled in value despite the recessionary risks. Inflation is what investors are most worried about. Now, gold is therefore playing the main role as a haven asset alongside the US dollar. And the price of gold exploded 4% higher on Tuesday, hitting an all-time high in dollar terms of $2,078 per ounce. And the moves are thanks to the perfect storm of inflation pressures, geopolitics, investor fear, and falling real yields. And these are exceptional market moves, but the market sentiment can change in an instant. And on Thursday, news that the oil supply from the Middle East may be increased, along with hopes of a dovish pivot from the European Central Bank when it announces its latest policy decision today, plus rumours that the European Union may issue joint bond sales in order to fund energy and defence spending, put a rocket under European equity markets yesterday. Now, the idea of huge fiscal and monetary stimulus to combat the economic impacts of the war, plus a plunge in the price of oil, sent the Euro Stoxx 50 up 7.4% on Wednesday, while the German DAX rallied almost 8% on the day. Now, meanwhile, commodity prices slumped along with the price of gold, which fell back towards the $2,000 per ounce level. Now, analysts went scrambling for the history books to see if there had ever been such a powerful move in a single day in European equities, and it led to calls that the bottom of the equity market is now in. Now, at the end of last week's note, I wrote that there were signs of bullish divergences between the relative strength index on the S&P 500 and the index itself. Now, to understand what I mean by that, listen to the Money to the Masses podcast episode 348. But interestingly, the divergence continues. But at the same time, a death cross looks likely to occur in the coming days between the 50-day moving average and the 200-day moving average on the S&P 500, which is something the Nasdaq 100 achieved last week. So it shows you we're in this mixed, quite confused market, and the bulls will want to capture 4,300 on the S&P 500 if they are to build on the positive momentum that we've seen in the last 24 hours. And it currently sits at 4,277. For European equities, on the other hand, much depends on what the ECB and the EU announce. And if they disappoint, and the market could turn right back around. Now, nearly all equity markets still sit below their 200-day moving averages at the moment, which isn't particularly a good look. And from a technical analysis perspective, there is not yet too much to cheer about, especially with the German DAX, despite the near 8% rally yesterday. And to give you some context, the DAX is still down for the week despite that rally. So it's a difficult market right now, and the traditional bond equity portfolio is continuing to get hurt. Those who diversified into gold, commodities and energy stocks are still faring better for now anyway, but everything could change in a blink of an eye. Now, the ECB is the first central bank to meet after the start of the war in Ukraine, so it will be interesting to see what is announced. The US Federal Reserve and the Bank of England announced their latest policy decisions next week, and these are likely to take on even greater importance than usual in determining the future direction of equity markets. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com. You can contact me via Twitter, moneytothemasses with the number 2. We're on Instagram, Facebook, TikTok, and of course, don't forget to subscribe to our YouTube channel.